chapter 2 is dealing with describing the balance sheet. So now looking at the different financial statements. So as we said before, so the balance sheet is the document that is used to record what you own, which remember are assets, what you owe, which are liabilities, and your net worth on a specific date. And as we said before, assets are something that you own that benefits you now or into the future. Liabilities are obligations, sometimes referred to as debt. You owe cash to someone else. So they're expecting you to pay something at a future point in time. And then your net worth is what is left if you were to cash out all of your assets at their recorded values, and then you were to pay everything that you owe, what would be left over. So again, assets are things such as cash. It could be a car. It could be a house, furniture, investments. Cash is typically listed first because it's an asset that can be that can be most conveniently exchanged for other things, meaning it can be liquidated first. Liabilities are things that you owe. So examples would include unpaid accounts, for example, credit card bills, cell phone bills, medical bills, that kind of a thing. Bank loans, mortgages, those are liabilities. And so remember that your net worth is your assets, your total assets minus your total liabilities. Now, the balance sheet provides a snapshot of your financial position. The date of the balance sheet is presented as of this date. So for example, the balance sheet prepared on December 31st of 2023 would have the date as at December 31st of 2023. The difference between the value of what you own and what you owe, as we said, is your net worth. And so in the example here, we see that the total assets are $75,000 and what they owe is $50,000. So then the net worth then would be $25,000. All right. So a personal balance sheet A has more cash than personal balance sheet B. Thus, however, personal balance sheet B has more investments. Therefore, personal balance sheet B has a higher net worth. And so we see there listed A, the amount of cash, the amount of contents of the home, other things, their furniture and such, the amount of their value of their car, and the value of their home. And so we see there the total assets, and then we have their total liabilities. They have 105,500 in liabilities. So that leaves that they have their net worth of 36,005. And then we see in B how it's listed as we said. And then looking at this in personal balance sheet C, has a bank overdraft of $2,000, meaning they owed the bank $2,000. And then on personal balance sheet D, they have cash of $50,000. However, personal balance sheet C has a higher net worth than all four personal balance sheets. A high or low cash balance does not necessarily imply a high or low net worth, and that's something to be aware of as well. Just because you have cash, that doesn't necessarily mean that you have a high net worth, or when we start talking about in the context of a business, you start talking about equity, meaning that they have a lot of equity. That's not necessarily, so you have to look at everything to determine that. Remember that the net worth, as we said, is the assets minus liabilities. And when we get there, net worth, when we start talking about business, we'll say that net worth is our equity. All right. So what is the role of the balance sheet? Does it record expenses? Does it record what we earn versus what we owe? Does it record what we own versus what we owe? Or does it record all of the financial transactions? And it is C, that it records what we own and compared to what we owe.